My name's Josh Duitz. I'm Deputy Global Head of Equities at abrdn. abrdn's one of the largest asset managers in the world. I think it's important to define what the macro environment is right now and then explain why we're bullish on infrastructure. So if we look at the major impacts of what's going on, it's first inflation. Several months ago, people talked about inflation as it being transitory, and that was a consensus view when we saw higher used car prices. And then we talked about the supply chain, and then the war in Ukraine having an effect on energy and food prices. And now what we're really seeing is that inflation is ubiquitous. It is everywhere. In everything you buy, we're seeing higher prices. So what does that mean? It means that the Fed and central banks globally are going to have to start raising rates, which they've already have done, and they've become even more aggressive in raising rates to try to tame the inflation that they were not expecting. And what does that mean? It could lead to possibly a recession. We're not sure if we'll have a soft or hard landing, but a recession. So what do you really want to own in that type of environment? You want to own infrastructure. Infrastructure is a natural head towards inflation, so it takes on the first part as they get to raise prices with inflation, and we can talk a little bit more about that. And also, you really want to own companies that earnings are resilient. When we look at infrastructure companies as a whole, the global listed infrastructure index, even during the Great Recession, the GFC back in 2008, EBITDA was still growing at the time. These are the type of companies that you're going to use. You're going to drive in the roads. You're going to use your utilities regardless. So their earnings are really resilient during recessionary time periods. Infrastructure really is the type of asset class you want to own in this environment. Infrastructure performs well in inflationary environments because many of the prices are linked to inflation, some explicitly and some implicitly. So I'll give you a few examples, such as on roads. And every concession contract is different. So generally, when there's inflation, on a yearly basis, you get to raise your toll or tariff with inflation. So really a perfect hedge for inflation, and it depends, again, on the contract. Same thing we see in regulated utilities. There's an inflation link. On towers in Europe and in emerging markets, there's an inflation link to their revenues. Some are less explicit, but these are still infrastructure monopolistic type assets. So they have monopoly type pricing power to it. So they get to raise a toll or tariff or the rate that they're being charged. And that's what we really like about infrastructure assets and the ability to raise that price during an inflationary time period. So it is a great hedge for inflation. But you do have to look at every sector and every concession contract separately to understand what is actually the true link. So there's two sectors I would say in this environment that are extremely attractive. And that's because not only do they have the pricing power and inflation protection, as we just talked about, but there's really tailwinds to it. And their earnings should be resilient even during a recession. So the first sector is the tower sector. And that's what's really driven by 5G spending. The towers are those large structures that you see around that really allows the cell phone networks to operate. And what we've seen is a transition from 4G to 5G. We're at the beginning stages of that transition. A 5G phone uses about 2.5 to 3 times as much data as a 4G phone uses. We've seen data grow by 30% per year over the past 4 years. So we're using about 15 gigabytes of data a month for a cell phone. So that's triple the amount of data we've used over the past 4 years. And we expect that to, again, triple over the next 4 years. And the towers will be the biggest beneficiary of that, or one of the largest beneficiaries. So really, even in an inflationary environment, even during recession, we believe people are still going to use their cell phones. There's about 1 billion 5G users today. We expect that to grow up to about 4.4 billion 5G users by 2027. So, and also on towers, especially in Europe, you generally, in emerging markets, you get to raise your toll or the amount they charge into the cell phone companies with inflation. So good inflationary hedge, as well as tailwinds that are going out. And we've already seen that spending. The tower companies have reported that they've seen the largest tower activity last year due to 5G spending, and they expect that to go throughout the rest of the decade. So really good opportunity for growth even in a recessionary environment. The other place we actually see a great opportunity to invest is in the energy transition. Energy is always changing. Prior to the pandemic, everyone talked about climate change and the spending on it. And because of the pandemic, that only accelerated it. And it's not only because of climate change we're seeing the energy transition, the cost of wind and solar has dramatically come down and is on parity with many hydrocarbon alternatives currently. So now it makes sense economically as well. Over 75% of countries globally have committed to reducing emissions. Just to put that in perspective, in 2019, only 25% of countries committed to that. So we're seeing it globally that countries are willing to spend on, and they need to spend on it. Just for the Fit for 55, it's expected that Europe's going to have to spend about $3.7 trillion on that. So just enormous amounts of money to spend on it. So that's going to happen whether we have a recession or not, whether there's inflation or not. So really a great opportunity within infrastructure to invest. So what happened with COVID is governments globally were announcing stimulus packages with a real focus on infrastructure. So that has only accelerated the trend we were seeing, especially for the energy transition prior to COVID. We expect that to continue. Now, the war in Ukraine, what's happened is Europe has now a very ambitious plan to cut their imports of Russian gas by 2/3 just by the end of this year. And they just recently announced, as part of that plan, one of the things they're going to do is a permitting process for renewable projects. It used to take 4 to 9 years. Now they're reducing that to 1 year. In addition, they want all new commercial and residential buildings to have a rooftop solar obligation on it. So that's going to be put in place during this decade as well. So just accelerating the trends that we've already seen going on. So there's several ways an investor can. The retail investor in the United States can buy different stocks, obviously, but I will caution that in order to buy, quote, an infrastructure stock, you should really understand the contracts and let the contracts of duration. What it means is it truly an inflation hedge. Alternatively, there's funds you could buy on the public side. There's several infrastructure funds that invest in public securities, such as at Aberdeen, we have AIFRX, Aberdeen Global Infrastructure Fund. On the private side, it's extremely difficult for the retail investor to have direct investments because you have to be a qualified investor. 2 years ago, Aberdeen launched ASGI, the Aberdeen Standard Global Infrastructure Income Fund, which allows retail investors to invest both in public and private infrastructure within one vehicle. And the closed-end fund really is a correct, in our opinion, the best vehicle to invest in private infrastructure for the retail investor. If you had it in an open-end fund, there's issues with redemptions and subscriptions. With a closed-end fund, you have a set pool of capital that really allows an investor and the manager to manage that money and invest in both public and private infrastructure at one time. So those are really ways that an investor can invest.